Gold, of course, has traditionally been viewed as a hedge against inflation, but in this high inflation environment, the precious metal has disappointed many investors, even as inflation has touched four-decade highs. What's driving gold prices and what are the bright spots in the sector for investors? Joining me now is Robert Cohen, Vice President and Portfolio Manager at Dynamic Funds. Robert, thanks a lot for joining us. Why has gold languished to some degree? It certainly has not broken through the $2,000 threshold and stayed there, as were the forecasts in 2021 at the beginning of 2022 as well.
Yeah, I think you have to sort of look at it from the right time frame. I think people are looking at things on a really short time frame. And what we've had is a bit of noise here in the first quarter with the war that broke out in the Ukraine. And there was, for a while there, fear that it could escalate into perhaps World War III. So you had the gold price spike up and then kind of come back down. So if you look at it on a year-to-date basis from January to now, and because we're in Canada, let's just talk about gold price in Canadian dollars. The gold price is down only 2.1%, while the TSX, as of today, is down 14.4%. So on a relative basis, gold is doing its thing. It is hanging in there. Just because it's not up doesn't mean that it's not doing its role as a hedge against inflation.
Yeah, in fact, just before we began our conversation, I ran on my Bloomberg screen a comparison between the S&P 500 this year in US dollars, of course, and the active gold contract in US dollars as well. Gold is down 7%, but the S&P 500 is down by more than 21%. So is that another instance of gold doing its work, as you phrase it?
Exactly. Yeah, exactly. There's a bit of noise there, but I think you got to look at things over a little longer time frame. You get sentiment kind of making a lot of noise, especially in the gold stocks. You see these gold stocks down 20, 30, 40% year to date. That makes no sense at all.
So that's one of the big questions that always face investors who want to invest in this space. Do I buy physical gold or futures gold or securitized gold, you might call it, in the way, for instance, of an ETF that gives you direct gold exposure or direct exposure to gold futures? Or do I buy the shares of big gold mining companies? How do you view that discussion right now?
I was going to just put a plug in for the Dynamic Precious Metals Fund. If you want equity exposure, I'll just say if you don't have experience, leave it to the experts, leave it to a seasoned portfolio manager to do that work for you. But if you want physical gold, that is fine. You can buy gold certificates, ETFs. It's all the same. At the end of the day, you always have an ounce of gold. When you're in the equity market, you have an equity related to the gold price, but it can get, add more risk, but more return. So it just depends on your risk tolerance. What do you want to own? But I think that, you would have to discuss with your financial advisor what you really want to do.
Your fund invests in shares of gold mining companies, correct? And does not invest in securitized gold in one fashion or another.
We actually have two gold funds. So one of them actually does utilize physical gold, and one of them is an all equity fund. And the reason why we have two different funds is to appeal to two different subsets of investors out there.
We've seen a huge run-up, as you know, in energy shares last year and this year, and one reason why is that there's a lot of discipline in the sector now, where companies use their excess cash flow to send it back to shareholders in the form of higher dividends or share buybacks. Are gold companies doing as much as they can or should to return capital to shareholders?
That's still up for debate. I think there's a lot of improvement that can still be done, because in the gold space, the dividend yields that these companies produce, when you're competing with, for example, Canadian banks and so on and so forth, it isn't that exciting, to be honest. But I think there are ways for companies to return capital, get a little bit more disciplined with their allocation of capital. Always been a problem in the industry, but this is why you want a seasoned fund manager, because we sort through the good, the bad, and the ugly, and just give you the good, hopefully. So
Okay, you've got a couple of stocks that I believe you like. We can bring those. I think we have a board that we can show our viewers. Kinross Gold, a well-known name in the sector, ticker symbol K, and K92 Mining, perhaps a lesser-known name. Let's begin with Kinross.
Well, Kinross is one of the more senior mid-cap or senior companies in Canada, or globally for that matter, growing to about 2.3 million ounce per annum production between now and 2023, 2024. But I think one reason I really like Kinross is their recent acquisition of Great Bear. I think Great Bear is one of the most exciting exploration plays I've seen in my career. And I think they were really smart to buy it. And while this won't be a mine until 2029, I think that this represents what will one day be a huge resource, lots of exploration potential, so it will keep growing and growing. In terms of K92, this is a new gold mine in Papua New Guinea. They're expanding it in phases, so they're going into their phase 3 expansion. And they will be producing over 300,000 ounces a year, low cost because they got copper byproduct credits. They're on a hydropower grid. They have lots of exploration potential, high grade. We're talking around 10 grams a ton. So in both cases, you check the boxes of grade, profitability, insulation against rising costs, good management. So I think these are both going to be successful companies. I think K92 is more of a short-term re-rate and Kinross a longer-term re-rate.